All right, so recently we had the S&P 500 on Friday close at an all-time high, and the big question that's probably on a lot of people's minds right now is, should you be buying, should you be selling, and, various iterations of that. And my position is quite clear, and it's always been my position. My position on the topic is you never stop buying. Now, again, the question also would come down to, are you an index investor, or are you someone that does a combination of the two, or do you not buy indexes and just buy stocks? I do a combination of the two. I would say probably 80 to 90%, probably 90% of my buying is regular stocks and the other 10% is indexes. And my position, like I said, is I never stop buying. All I do is I adjust the amount that I am buying, or I adjust what I'm buying. And the one thing to point out here is, even though we're at an all-time high in the S&P 500, there's still a lot of companies that I think are either buys or at the very least at fair value that you still can be buying. I will get into that in a little bit. The other question here that a lot of people have is, why not wait for a pullback to buy in? And that's a very good question, because there certainly will be a pullback. Well, not certainly, but very, very, very likely there will be a pullback. It could be 5%, it could be 10%, 15, 20, 30, 40, we don't know. The problem with waiting for a pullback to get in is nobody knows when it's going to happen or how large the pullback will be. For example, I believe the average largest pullback in any given year is about 10 to 15%. Don't quote me on it, but I think that's the number. And again, a lot of people say, okay, well, we're at an all-time high. I'll wait for that 10% pullback. I'll sit in cash until then, and I'll be looking mighty when that pullback happens. There's several problems with that. Number one, it might not happen. Number two, we easily could pull back 10% and then pull back another 10% and maybe even another 10%, right? So nobody knows how deep the pullback's going to be. And number two, again, it might not even happen, right? It might not even happen. So that's a very important thing to think, is that there's no way you can time the market, which is why I like my strategy. And my strategy, like I said, is I'm going to buy a certain amount every month, no matter what. If I feel like the market is extremely undervalued, I'm simply going to increase the amount that I'm buying by a little bit. If it's overvalued, I will just decrease it by a little bit. But the number never changes that significantly. Like right now, I'm a little bit more in cash than I normally am, but it's not that much. It's maybe an extra. Normally, I'm maybe honestly 5%, maybe 10%. Now I'm maybe 15%. Like, it's not that much different. And again, a lot of people would disagree with that, but again, that's my opinion. So anyway, like I say, to state it quite clearly, nobody knows when the market will pull back, if the market will pull back, and how much it'll pull back. And it is way too hard to predict that. Therefore, you're better off just continuing to dollar cost average into good companies and forgetting about the rest. So anyway, as far as what I think will happen, my prediction would be, again, my prediction, I think that we probably stay fairly choppy over the next few months. I think the market is really waiting to see what the Fed's going to do. But given we're in an election year, I think it's pretty unlikely we're going to see an extreme correction. And if we do, I think we'll see the Fed overreact to the other direction like they did in 2020. And again, we'll go right back up again. So again, it's not that we couldn't see like a 30, 40% pullback. That wouldn't be surprising. It wouldn't surprise me. But again, I'm not betting on it. I mean, it would surprise me, but it's not something that I would completely unexpect, or I would see as being completely unexpected. So anyway, there is a handful of companies that I do own that I think are either fair value or below value based on valuations. And again, if we're getting right into it here, the first one, Vici Properties, again, based on its historical price to FFO, again, it's not actually that high price-wise. Again, the price to FFO is actually 16% below its 5-year average. Now, again, you can argue that's a little expensive, but again, historically, it is undervalued. And this is actually a company that's actually down over the last year. So, again, I think that that's one to look at for sure. Again, obviously, all of these, do your own research, consult a professional, etc., etc. The next one is Amphenol. Again, another company that I really like. Again, if you look at its valuations here, price to free cash flow, it's actually a little bit below PE, and price to sales, it's a little bit above. So it's probably about fair value where it's at right now. But again, not super expensive by any means. The next one is Visa, which is actually at an all-time high right now. But if you look at its valuations here, it's actually below its 5-year average price to sales, price to free cash flow, and PE. So again, if anything, it's probably fair value where it's at right now. And honestly, Visa is one of my favorite companies. Again, this is just an absolutely phenomenal company. Anytime we see a clear pullback in a company like this, I would be dying to get in. Again, just my opinion though. The next one is Microchip Technology. Again, another company that I really like. I think this company is worth probably $100, $110. Again, it's right around 90 right now, meaning I'm all over it. Again, it is below its historical PE by a lot, historical price to free cash flow as well. Again, a company that's this profitable and growing this well, to have a price to free cash flow of 15, I think that's a very good deal. The next one is Agilent Technologies. Again, another company that I like. Again, 23% below its historical price to free cash flow. It's also below its historical PE and price to sales. So again, if anything, this is a discount where it's at right now. The next one is United Health. Again, this one, I think that this one definitely could have some regulatory concerns in the future. But I mean, where it's at right now, it's basically a little bit below fair value by the looks of things. So again, this is one that I keep as a very small position, but I think if it doesn't get overly regulated, this is a company that's going to keep doing very well. The next one is FTNT. This is another one I really like over the long run. Again, it's down quite a bit on the year or over the last year. Again, it's significantly below its historical PE, price to free cash flow, and price to sales, although those were definitely expensive, so I wouldn't expect it to be trading that high long term. But again, a price to free cash flow at 22.85, given how fast it's growing, how profitable it is, I think that that's a good deal. And the last one, again, obviously these are all ones that are just ones that I own. Again, no particular order, none of that kind of stuff. Again, do your own research, like I said. The last one here is Paycom Software. Again, another company that's extremely profitable, growing extremely well. Again, significantly below all of the historical valuations, although those historical valuations were extremely expensive, so I wouldn't take those as gospel. So anyway, like I say, to sum it up, I think that there's still a lot of areas of the market that you can be buying right now and not feel like you're paying top dollar. I think the market on average is definitely a little bit overextended. That's certainly fair to say. But there is pockets of the market. And not only that, there's pockets in most sectors that I think you can be buying right now. So again, if you're vigilant, there's certainly companies that you can be buying right now. So anyway, that's what I wanted to bring up today. If you liked the video, please like, comment, subscribe, and stay tuned for more.